Hey everyone, let's jump right into this explainer. Today we're putting Kosmos Energy, ticker KOS, through an absolute financial gauntlet. We're talking a rigorous stress test to see if its current stock price, which is hovering right around 287 to 289, can actually hold up to some legendary investment frameworks. As an investment analyst, I gotta tell you, I love doing this. We're going to take this deep-water exploration company, completely strip away the market noise, and apply the cold, hard math of the world's greatest value investors to see what is really under the hood here. So here's our roadmap for the analysis. We're going to start off with a quick company snapshot, then evaluate the stock through the strict lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll build out our valuation and DCF models and wrap it all up with a final recommendation. Let's get to it.
Starting off with Section 1, our company snapshot.
To set our baseline, Kosmos is a deep-water exploration company with operations spanning the globe, places like Ghana, Equatorial Guinea, Mauritania, Senegal, and the Gulf of Mexico. And, at first glance, it looks like the market is rewarding them. The stock actually popped 7.1% recently, all on the promise of a strong 2026 outlook. It seems like investors just looked right past a Q4 2025 earnings miss, totally distracted by that shiny forward guidance. But as analysts, we have to focus on the numbers they're printing today, not just the promises for tomorrow.
And this brings us to a massive, striking contrast. On one hand, Kosmos is hitting record production highs, literally generating 74,800 barrels of oil equivalent every single day. That's a massive 25% jump year over year, mostly driven by their Greater Tortue Ame project finally ramping up. Revenue sits at a solid $371 million. But here's the reality check. They are completely burdened by a heavy $226 million net loss and a truly staggering $2.8 billion in net debt for the first quarter of 2026. Bottom line? That translates to a negative earnings per share of 45 cents.
All right, moving into Section 2, the Buffett lens.
Before we crunch the numbers, remember that Warren Buffett demands two crucial things: an impenetrable economic moat and really strong owner earnings. Now, owner earnings basically represent the true cash a business generates for its owners after dealing with capital expenditures. For Kosmos, we're estimating this by looking at the reported Q1 free cash flow, which was a pretty meager $14 million.
When you look at this checklist, it's pretty clear. Kosmos completely fails the Buffett criteria. As a pure price taker in the global oil market, they have absolutely zero pricing power. So right off the bat, no economic moat. Their earnings are incredibly inconsistent, which is painfully obvious from that 45-cent loss per share. The return on equity, negative. And that $2.8 billion mountain of debt is the exact opposite of what Buffett would call manageable. I mean, management just had to issue a $350 million bond in the Nordic market and raise another $200 million in equity just to accelerate their debt paydown. Buffett absolutely hates dilution, and he hates heavy leverage even more.
So without a moat, without any consistent owner earnings, and severely lacking any sort of margin of safety, Warren Buffett's theoretical buy price for this stock is exactly zero. Literally $0. It wouldn't even make it onto his watch list.
Let's shift gears to Section 3, the Lynch lens.
Peter Lynch categorizes companies into specific buckets to understand their story. Well, based on their incredibly erratic earnings and that massive debt load, Lynch would immediately classify Kosmos. Definitely not as a consistent grower, but firmly as a cyclical stock or a high-risk turnaround play. They are completely at the mercy of global commodity cycles.
But wait, you might be wondering, what about the PEG ratio? Lynch famously uses the PEG ratio, which is the price-to-earnings multiple divided by the growth rate, to hunt for hidden value. Usually, a PEG under 1.0 screams buy in his playbook. So how do we calculate that for Kosmos?
Well, here's the catch. Those negative earnings completely break the PEG ratio. It's mathematically invalid here. You simply cannot divide a negative PE by a growth rate and get any kind of meaningful number. When you combine this broken metric with a weak balance sheet that's requiring massive equity dilution, Peter Lynch would undoubtedly give this stock a firm avoid rating.
Now on to Section 4, our strictest test yet, the Graham lens.
Benjamin Graham is the father of deep value investing, and his defensive checklist requires safety above all else. Sure, Kosmos passes on having adequate size, but look at the rest. That crippling $2.8 billion in debt, the complete lack of earnings stability, and absolutely zero dividend record, that means Kosmos is instantly disqualified for a defensive investor. It's not even close.
Beyond the checklist, Graham also uses a very strict mathematical formula to calculate a stock's intrinsic value. He takes 22.5, multiplies it by the earnings per share and the book value per share, and then takes the square root of the whole thing.
But we have to make a crucial assumption here. Because Kosmos's Q1 EPS is negative 45 cents, the formula literally breaks mathematically. You just can't take the square root of a negative number in this context. Because of this, Graham's required margin of safety can't even be computed. He demands absolute safety, and he wouldn't touch this stock at its current price under any circumstances. Okay, the value gurus have spoken. Let's move to Section 5, Valuation Models and our DCF.
If we want to build our own base case discounted cash flow model, we have to make some specific assumptions. First, we forecast the future free cash flows. Then we calculate a terminal value. And for a cyclical commodities business, we generally assume flat or very low perpetual growth. Finally, we discount all of that back to the present using an assumed industry standard weighted average cost of capital, or WACC. For a highly leveraged energy producer like this, we'd have to assume a WACC of at least 10 to 12%.
Now let's look at the cash. If we generously take their Q1 free cash flow of $14 million and extrapolate it out for the whole year, we only get a baseline of about $56 million to start our model. Think about that for a second. Even if they hit all their aggressive cost reduction targets, throwing just $56 million in free cash flow against a massive $2.8 billion wall of debt makes it incredibly difficult to generate a positive fair value per share for equity holders. The debt just swallows the enterprise value whole.
And when we factor in alternative valuation models, like an EV to EBITDA approach, that massive debt load continues to punish the stock's intrinsic value. This actually aligns perfectly with Wall Street's analyst consensus model. The base target sits at $2.21. Compared to today's price of roughly $2.89, that implies a 23.5% downside risk. And remember, that $2.21 target completely hinges on them actually delivering on those aggressive 2026 production promises. If they miss that guidance, the floor drops out even further.
All right, let's bring it all together in Section 6, Synthesis and Final Recommendation. Looking at our master scorecard, guys, it is a clean sweep of red flags. Warren Buffett's framework values it at exactly 0 because it lacks a moat and has unmanageable debt. Peter Lynch says avoid because of the negative earnings and it being a high-risk turnaround. Benjamin Graham's defensive metrics disqualifies it completely, and our modern DCF and analyst models imply a 23.5% downside risk to about $2.21. Every single traditional value investing framework is screaming at us to avoid Kosmos at current prices. We have to rate this a definitive sell, or at the absolute best, a highly speculative hold for turnaround gamblers who are betting entirely on future oil prices.
And really, the reality of the situation brilliantly illustrates the core conflict of Kosmos Energy. On one side, you have the operational triumph of record-setting 74,800 barrel a day offshore rig production. It sounds great, but on the other side, that operational success is completely overshadowed by a dark horizon of massive structural debt. Debt that literally requires continuous equity dilution and bond issuances just to keep the lights on.
So I'm going to leave you with this final thought to consider for your own portfolio. When the absolute best-case scenario for a company is just grinding away for years simply to pay off old debts, is the turnaround potential of Kosmos Energy truly worth the deep water risk? Thank you so much for walking through this analysis with me. Keep stress testing your investments, and I'll see you in the next explainer.